This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters in New York City. Man, what a Friday. Jobs Day, tariff deadline, President Trump deploying nuclear subs, citing a Russian threat. And Tim, we definitely have seen markets bouncing around to all of it.
Yeah, bouncing lower on the equity side right now. Charlie Pellet's going to have the details in just a minute, but suffice it to say the NASDAQ getting hit to the downside of about 2.5%. We're going to see 1% losses at least today, 1.8% on the S&P 500. Again, Charlie's going to have more on the yield side. Carol, steepening of the U.S. rates yield curve, also a market update in just a minute.
Yeah, those charts very clear when it comes to U.S. rates. Hey, as we said, we are focusing on that jobs report, a recap of the data you need to know. A lot of data, actually, today. Also, Fed folks out there speaking Fed policy. We're going to ask, does it still make sense coming off of that Wednesday decision, Tim?
Also, people all in on Apple and Amazon? I don't know. Amazon, not so much. Apple faded when it was higher earlier in the session. Needham's Laura Martin is back with us. She's going to give us some updates after those calls late last night.
Yep, and it ain't all about the Mag 7. We've also got some earnings from some of the big oil majors. Exxon and Chevron reporting results. Despite lower crude prices, they had record oil production numbers. So we're going to get into that. Ellen Wald, great voice on this. So she's going to join us in the next 60 minutes.
All that and more coming up this hour on Bloomberg Businessweek Daily. But he's back, the man, Charlie Pellet. Hey,
Thank
Charlie.
you very much. And let's recap reset here. A number of developing stories. We got you covered on Bloomberg Television and Radio. President Trump says the U.S. is moving to nuclear subs to respond to what he calls highly provocative statements from former Russian President Dmitry Medvedev. Stay with Bloomberg for the latest. Also, the Corporation for Public Broadcasting says it will begin to wind down operations after President Trump signed a package of spending cuts that ended its federal funding. We've got traders now quickly boosting bets on Fed rate cuts. They're now fully pricing in 2 quarter-point reductions this year after this morning's jobs report. Right to the numbers with the S&P now down 113. We are close to session lows on the S&P, 62.25 where we stand, down 1.8%. The Dow down 645. That is a drop of 1.5%, while NASDAQ down 2.4%, tumbling 512 points. The Mag 7 index down 3.2%. Apple, which is one of the stocks in that index, down 2.4%. Amazon plunging 8.6%. We got more on both stocks coming up right here on Bloomberg Businessweek Daily. Your 10-year 4.22%, with the 2-year 3.71%. Gold up $58 the ounce, up 1.8%, and West Texas Intermediate crude down 2.8%. Bitcoin down 1.8%, 114,369 now on Bitcoin. And word from Blackstone, it will reopen its New York headquarters on Monday after a shooting spree that killed 4 people, including one of its senior executives. Recapping S&P down 1.9%, I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you just heard from Charlie, stocks definitely dropping back. U.S. Treasuries rallying, short-term yields posting their biggest drop in a year after that softer U.S. jobs data prompted traders to boost bets that the Fed will lower interest rates as soon as next month. Remember, we just had a meeting and decision on Wednesday. We also got some data when it comes to consumer sentiment. We're going to get into all of it. Keep in mind that blackout period for Fed officials is over following that Fed decision on Wednesday. On that, Fed Bank of Cleveland President Beth Hammack, a voting member of the FOMC, talking with our own Michael McKee this morning. She said the U.S. labor market still appears healthy, though today's fresh jobs numbers constituted a, quote, disappointing report, to be sure.
When I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data. We look at the longer term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully. I feel confident with the decision that we made earlier this week.
All right, that, of course, was Fed Bank of Cleveland President Beth Hammack voting FOMC member with Michael McKee. Mike, of course, is Bloomberg News TV and Radio International Economics and Policy Correspondent here in TV. So she feels confident that with the decision that the Fed made this week. Did they get it right, Mike?
Yes, in the sense that as of noon on Wednesday, with the information they had.
So they didn't have this information.
They didn't have this information, and it doesn't necessarily mean they were wrong. It's not a great look for the economy at this point, but then it's always easy to look back in hindsight and say you should have done this or should have done that, but they still can move in September. And it's not like, because of the way monetary policy works, it's not like they're going to cut rates and all of a sudden the economy booms. It takes time for that to get into the overall economy, and there's still an enormous amount of uncertainty about what's going to happen because of tariffs. And so you could say that well, I would say Chris Waller is justified in taking something of a victory lap by saying he saw cracks in the labor market that he was worried about, because we do seem to have those. But Hammack said at the same time, you have to realize that we've all forgotten in the last 24 to 48 hours that inflation went up in the month, and inflation probably is going to be driven higher by tariffs. So does that mean you cut rates, or does that mean you hold rates because you want to bring inflation down?
Well, we'll get to more on the inflation part in just a minute. I want to focus on the labor market part of this, and specifically on the cracks that you referred to. What were the biggest cracks that you saw in this report? Was it a miss on the headline number? Was it revisions to the downside for previous months that were pretty ugly? Or was it, as Joe Weisenthal pointed out in his newsletter today, the concern about what sectors are actually doing the hiring, the low productivity sectors such as healthcare?
Yeah, that has been a concern for a couple of months. But the healthcare sector has been for a couple of years now the highest, the one that gains the most, because we have so many baby boomers hitting retirement and they need healthcare and all that sort of thing. It was the revisions that have really spooked the market and will give the Fed pause, because the labor market was obviously a lot weaker than they thought it was. And when you look at the revisions, it's definitely an issue. The question is, why did the numbers get revised like that? And it appears that it's a seasonal adjustment problem, because most of the revisions came in the areas that surprised to the upside last time. Government hiring at the state and local level, which is basically teachers and people at schools, and they seem to have a problem with when the schools get out adjusting for that. And this is something that we've seen a couple of times since the pandemic. So the pandemic, it's like one of those viruses you carry around that sometimes is dormant and sometimes pops up. We're going to have to see if this continues, that kind of problem.
What about the unemployment rate? So it's an uptick from the prior month, bang in line, though, with what the street was expecting. Claudia Sahm was on surveillance earlier this morning, and she says, yes, weaker labor demand, some softening, but the workforce is getting smaller as folks age. You also have the borders, not people crossing the border, so immigration. And she said the Fed can't change labor supply. So are we going to continue to see a smaller labor pool, and so we will see folks maybe fighting for workers? Well,
demographically, yes. We have the generations following the baby boom are smaller, and they keep getting smaller. And so we're going to have just a demographic problem going forward. And that's something that people have been talking about, and how all this plays out with AI is a conversation we can have another day. But the other thing that's happened is we've run into this immigration situation now where the administration has been throwing people out of the country as fast as they can. We had 341,000 fewer foreign-born workers in the labor force in July than we did in June. Now, they haven't deported 341,000 people, but it does suggest that there are a lot of people who are hiding from either ICE or from the survey takers, and they are not letting people know they're in the labor force. So it does get harder to find workers. And we saw in some of those categories, like construction and manufacturing and leisure and hospitality, we saw job losses.
Right.
Mike, I want to end with one more reference back to your interview with Fed Bank of Cleveland President Beth Hammack earlier today. She didn't dismiss the jobs report, but she did, to remind everybody, said that she tries not to make too much of any one individual report. So between now and the September meeting, what would you say would be data that would cause her to vote to cut rates at that September meeting?
I think it's going to have to be a combination. You'll have to see in the next jobs report for August, which we'll get at the beginning of September, does this trend continue that we see the economy slowing down? And to Carol's point about the unemployment rate, yes, it came in at 4.2%, but it came in at 4.248. So if we'd had just a very slight move upward, we would have been at 4.3. And this, as I said yesterday, the speed of the change in unemployment is what would worry the Fed. But we'll also need to see inflation level out or slow down its rise, because if the graph is pointing up and to the right in September on inflation, then it's a very hard sell for the Fed to cut rates.
Listen, Jay Powell talked about risks to both sides of the mandate. So.
Well, that's their nightmare.
Yeah.
Is, what do we do when either side is when they're in conflict?
Happy Friday, everybody. Mike McKee, thank you.
That's not even the worst news of the day.
Yeah. Now let's get to some other troubling news. Mike, of course, Bloomberg News, TV, radio, international economics and policy correspondent. Let's get to the trade journey. Today, the deadline, the extended deadline, remember, for countries to negotiate tariff terms with the U.S. Let's remind everybody of that journey. April 2nd was so-called Liberation Day. That set off a sell-off in global markets, followed 1 week later by a 90-day pause, excluding China, resetting the clock again until July 7th. Then in mid-May, the U.S. slashed the tariff rate on most Chinese imports, of course, a crucial trading partner with the United States. Early in July, the Trump administration gave another pause and another clock reset for countries to get deals done until today, August 1st. We got the latest terms last night with a start date of August 7th. It has been quite a journey. And U.S. Trade Representative Jamieson Greer was on Bloomberg TV and radio earlier this morning talking about the deals done thus far.
We've spent the past 120 days negotiating with dozens and dozens of countries, and with some of these countries, the deals have been good enough that the president's been willing to accept them. With other countries, they're just going to have a tariff. These deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system, and so we'll be, finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
All right. Of course, that was U.S. Trade Representative Jamieson Greer earlier on Bloomberg today. Keep in mind that despite the August 1st deadline, there are extensions and exceptions for the likes of Mexico, China, Brazil, Canada. Maybe you've heard of them. They are important trading partners of the U.S. Not everything's wrapped up. A lot to get to. We want to turn to Jen Dlouhy. She's had a busy day already. Bloomberg News senior reporter covering the White House. She's with us from D.C. Investors care about all of this. They care about uncertainty, Jen. It's been a big day of stuff coming at the financial markets. I have got to ask you, though, first about a headline about an hour ago. President Trump deploying 2 nuclear submarines, citing a Russian threat. What do we know about that?
Well, this is really a case of the president. He's kept up pressure on Russia rhetorically anyway, and has obviously, shrunk his deadline for the country to resolve matters with Ukraine, lest they face sanctions. In this case, he's clearly engaged in some kind of war of words with Medvedev. His response or his comments on social media today saying he was mobilizing these 2 nuclear submarines to respond to what was in response essentially to comments from Medvedev that he called highly provocative. And it just seems that there's a clear incendiary war of words between these two gentlemen.
Escalation between now and the weekend. Obviously, nobody has a crystal ball here, but this seems like escalation on its own. What should we be watching for?
You know, I think beyond this, we obviously are going to be looking for other telegraphs from the president about movement and military assets. But, the president has said very clearly he expects to hit Russia with sanctions on August 8th. And I think, we could be looking for any sharper words from the president as he travels to New Jersey later today, potentially speaks to reporters. Whatever he says there will send important signals. And of course, we're going to watch to see what he does with those sanctions. He could shorten the timeline even further.
I got to bring in, Jen, so much for a sleepy Friday in August. It ain't happening. President Trump out on social. I'm not sure if you're aware, so forgive me if I'm dropping this in your lap, but he just put out on social media. I was just informed that our country's jobs numbers are being produced by a Biden appointee, Dr. Erika McEntarfer, I think, the Commissioner of Labor Statistics. He writes, who faked the jobs number before the election to try and boost Kamala's chances of victory. He's got a long post here. He
has directed the team to fire the Commissioner of Labor Statistics. He said he's directed his team to fire this Biden political appointee. He says we need accurate job numbers. The job numbers are being produced by a Biden appointee.
Jen, what's going on here?
Look, you've seen the president for weeks and months now complain about the Fed and Fed Chairman Powell. And I think this attack just in on what he says is a Biden political appointee, suggesting that there's some games playing with the jobs numbers. I think you could put it in that same bucket of criticizing the bearer of some bad news, whether it's a decision to delay rate cuts or in this case, some jobs numbers that clearly weren't something the president was hoping to see today, especially as he's in the middle of proclaiming tariffs on U.S. trading partners.
Jen, if you would, sit tight because we want to come back to you on tariff and get an update on that. But we want to bring back Michael McKee, of course, who covers the Fed and the global economy. Mike, who is this individual?
It is Dr. Erika McEntarfer, who is the Commissioner of Labor Statistics, basically. She was nominated by President Biden and confirmed by the Senate in January of 2024. She's only been on the job for a little over a year. But this is a kind of outrageous accusation by the president. The BLS is not fudging the numbers. I guarantee you they're not fudging the numbers.
Mike, it reminds me of something that we heard before the election from then Senator Marco Rubio, who was questioning strong jobs numbers and during the Biden administration, and essentially coming out and saying, do we trust these numbers, and trying to cast them in a doubtful light when they were the other way.
Well, what this shows, I think, at base, leaving aside Trump's desire for revenge on everything, is that there are an awful lot of people who do not understand statistics and do not understand how to look at probabilities. The government in the report on jobs, the government notes that there is a margin of error of a little over 100,000 jobs per month. So we got 73,000. It could have been 173,000, or it could have been negative 17,000, and those would have been statistically valid results. You can't have a perfect number each time. We don't count every single person. Plus, it depends on how many companies send back their results at the right time, and that is that is a problem that we have seen more and more, that the government isn't getting the responses that they need. And then there's the statistical adjustment problem we talked about, where you're trying to account for changes in the labor force month to month.
And that's been true under President Trump, under President Biden, under President Obama. This statistical variation, that it could have been 100 more or 100 less. That hasn't changed.
That's been true since 1923 when they started doing these surveys.
Mike, we rely on this data, whether it's
the world does, to be quite honest,
absolutely.
Right? That our data is
investors rely on it, traders rely on it, macroeconomics professors rely on this. I mean, economists rely on this stuff. Over the last few years, when we've been talking about data from China, for example, sometimes we ask the question, can we trust the data coming out of a certain country? Is that an issue in the United States if this type of thing becomes politicized?
Oh, it's definitely an issue. The United States is the gold standard of economic statistics, and it has been eroded the ability to produce the best statistics because there's no constituency on Capitol Hill that is pounding on congressmen's doors saying, give more money to statistics. So every time they need to cut a little something here or there in the budget because they're spending on something else, they say, we'll take it out of the BLS or the BEA or the Census Bureau, and they won't notice, but they do. You end up with a degraded ability to get an accurate number, but that doesn't mean they're not statistically valid within the parameters of the margins of error, which are published, and all of the methodology for all of the statistics is published by all of these agencies, and the rest of the world would love to have the statistics that we have.
Is it unfair for me to ask that when the numbers came out in the prior month of 147,000, we pointed out they've been revised down significantly, but when they first came out, that the president didn't come out and question that number at that time?
Absolutely.
Is it fair to ask that?
Yeah, it's fair to ask that. And we've had this happen before where you do get even larger revisions as the numbers come in and they work. And Tim, you were talking about last year. What the government does is they survey establishments around the country for how many people are on their payrolls, and as I said, they don't always get all of them back, etc. And they try to make it as accurate as possible. But then what they do is once a year. But they do it every quarter, but they do a cross-check against people's tax records. So you can see how many people were on payrolls by what was withheld. And those numbers showed last year a significant overcount in jobs. And this year, they're expecting the same thing, that they have overcounted. And then they go back and they change the numbers and make them agree with the more accurate tax numbers. But that's just a normal statistical adjustment that's made. And, we do that with GDP. You get an adjustment after 5 years because they look at tax records and they see what was actually happening.
Michael McKee doing double duty for us again on that headline. President Trump saying he will fire a labor statistics head after this morning's weak jobs report.
It's just outrageous.
All right. Yeah, we're going to keep following it. Mike, thank you. Want to go back to D.C. Jen Dlouhy still with us, Bloomberg News senior reporter covering the White House, covering all of the trade. Jen, thanks so much for staying with us, because this is the other massive story that is coming at us again today and investors. So where are we with trade, tariffs? How are you thinking about, can we tie it up in a bow and say we're done? Because it doesn't feel that way yet.
I don't think we're done, and I suspect we're going to be talking about trade and negotiations for quite a long time to come. Of course, talks with China are continuing, and just yesterday, the president extended negotiations with Mexico for another 3 months. So don't expect anything to be ending anytime soon on that front. Really, what we've seen just in the last 24 hours is the president moving forward with his agenda and his plans to reshape the global commerce. We saw many trade partners with which the U.S. has a surplus in trade, generally being subjected to a 10% rate. Another bucket of countries got essentially a 15%. That's where the trade imbalance was lopsided, favoring them, but not maximally, not really bad in the eyes of the president, not a real problem. And then, of course, there were other countries with which the president had negotiated deals or set the terms, the EU, for instance, and Japan. And we saw all of that codified last night. But there's so much more to come, including details of how the administration is going to look at transshipment and even tariffs around pharmaceuticals and other sectors that are really important to the economy.
Well, even 48 hours ago, we were hearing Fed Chair Jay Powell talk about the uncertainty related to these tariffs and the latest on these. Give us just finally the president's end game, if you will. What is his ultimate goal here if we think about trade with the rest of the world? What does he want to see?
Yeah, no, I think the president has been really clear and his advisors have been clear. They want to see rebalanced trade with other countries. They want to address these imbalances and then also really start to tear down what they perceive as unfair barriers to U.S. goods being traded there. They're trying to lure more manufacturing to the U.S. And so far, the negotiations are winning some of those concessions. We've seen, greater market access promised for U.S. cars in Japan and Indonesia, for instance. It's of course, we shouldn't ignore that, the president and his advisors are clearly enamored with the tremendous tariff revenue that is coming in. Some of that is going to be from the 10% baseline tariffs, but already, it's over $150 billion this year. And, to the eyes of the president and many of his advisors, it's clearly a real opportunity to bring down the deficit.
Jen, amazing. You covered so much, and I know a lot coming at you out of D.C. and out of the White House right now. Jen Dlouhy, thank you so much. Bloomberg News senior reporter. I got to just point out, Jen and two other members of our amazing global team here at Bloomberg did a morning live conversation about tariffs and trade. We covered a lot of ground. You can find that at bloomberg.com/live Q&A. So I highly recommend you check it. All right, we're going to talk Mag 7 in just a moment with the one and only Laura Martin over at Needham. But right now, a check on trading and your top business stories with Charlie Pellet.
I thank you very much indeed. Very close to session lows right now, Carol. Do want to begin with a developing story out of Florida involving Tesla. A jury there has told Tesla to pay $329 million in damages over a 2019 autopilot crash that killed a young woman and seriously injured her boyfriend. Tesla shares down now by 1.7%. Treasuries rallied. Short-term yields posted their biggest drop in a year. The Dow, the S&P, and NASDAQ all in the red after this morning's jobs data. S&P right now down 112, down 1.8%. The Dow down 1.4%. NASDAQ hard hit down 2.4%. The Mag 7 index down 3.2%. Apple down 2.1%. Amazon, also a member of the index, down 8.6%. We've got more on Apple and Amazon coming up in a moment. 10-year jobs Friday, 4.22%. The 2-year, 3.71%. Gold is surging $58 the ounce, up 1.8%, while West Texas Intermediate crude is down 2.8%, $67.29 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, folks, let's get now to certainly something that the equity markets have been focusing on, all week, and that has to do with Mag 7 earnings. Right now, I'm looking at Apple shares. They're down about 2.1%.
They were higher earlier in the session, too.
They were. They actually showed some gains. That wasn't the case for Amazon today. It's been down as much as 9%, right now down about 8.6%. Both reported after the close last night. Apple posting its fastest quarterly revenue growth in more than 3 years, and yet Amazon projecting weaker than expected operating income and trailing the sales growth of some of its cloud rivals. So we definitely are seeing some impact. It's all against the Mag 7 that we've heard over the last 2 weeks or so.
Great to have back with us Laura Martin, senior analyst over at Needham Company, whose coverage of the media, entertainment, and internet spaces are a must-read. She joins us from Los Angeles. Laura, I want to start with Apple and the pull forward, or whatever we saw with the huge beat when it came to that iPhone number, and typically a time when people are not buying iPhones. How do you explain it? Was it all about pulling forward of demand to avoid tariffs?
It is really that. I mean, that's what the market's telling you today. Apple admitted that 100,000 basis points, so 1% of their revenue growth, which was 10%, well above average, was from pull forward. And the market's telling you they think that number was like half of the gain, basically, and Apple also said they had $800 million of costs from tariffs in that quarter they just reported, and it's going to go up to 1.1 billion visibly in the September quarter. But I think the market's telling you they think that could be higher in the September quarter.
Oh, so does this mean that we'll see fewer iPhones bought in the first fiscal quarter, but Apple's December quarter, which typically is its biggest quarter, as a result of the pull forward that we saw in this quarter?
I think it's worse. It's faster. So the June quarter over-delivered because they pulled forward demand from the September quarter. Those are all old iPhones.
Okay.
And then in late September, you typically get the new iPhone, and then you start this new annual cycle of the new iPhone. And one of the things they said that's hurting the stock today is that Siri and Apple Intelligence will only be integrated next year, by which they're probably talking calendar year, which means the earliest we'll see, generative AI features drive an upgrade cycle for the iPhone would be not September of 25, it'd be September of 26. So then that tells you, so this is dead money again, right? There's nothing driving. And there's risk here. Not only China's subsidies drove a really nice China growth number, 4.8% China revenue growth. People are worried that is also like that subsidy isn't going to recur. And we've had a couple negative litigation regulatory decisions, right? We've got the fee to $20 billion a year is what Google search pays Apple to be the default search engine on all iOS devices. I think that's pretty clear from channel checks in DC. That is not going to be allowed to persist. So that's $20 billion that will come out of services if it isn't allowed. And then similarly, we have the Epic. Apple got a negative Epic Games, which allows consumers to pay directly to apps and not have Apple share 30%. So that's an app store risk that over the next 12 months, not immediate, but over the next 12 months.
Laura, we've had the luxury of talking with you in the last week or two and talking specifically about Apple. You've got a hold rating on it. It doesn't sound like you have a lot of concerns, I guess I should say. Why not put a sell rating on it?
I think so. One of the issues is when you look at the other Mag 7, they basically have a singular strategy, which is envision. Generative AI is disruptive. Everyone else is going to spend $85 to $100 billion in CapEx in 2025 alone, and we're going to grow at 20% in 2026 every one of them has been pushed on what is that return on capital, incremental capital. They all say, we don't know. We just think it's going to be big. If you don't believe that, if you're an investor and you think that generative AI is overhyped or the economics are further off into the future, Apple is a great place to hide. They are spending $20 billion a year, not $85 billion a year. Generative AI is sometime in the future. They're not hiring people like Meta is for $100 million each to work on superintelligence. Apple is a great place to hide if you are an investor that doesn't believe in generative AI changing the world.
Well, it's interesting that you say that. I can't remember who was either on surveillance this morning with Tom and Paul, but it was just something to the point that, well, wait a minute. Apple often isn't, first mover on some big changes, right? We talk about this. They didn't create
the tablet. They didn't create the music player. They didn't create the smartphone, but they created the best of all those things.
Exactly. So if they're saying, hey, guys, go ahead and spend, your billions or trillions or whatever the heck it is, figure out this AI thing, and then we'll come in and we'll collaborate or partner with somebody. Maybe that's not such a bad strategy.
So it's risky business. So on the call last night, Tim Cook got this question. And what he said is, I don't see a world where the consumer doesn't have an iPhone, which is basically a computer, in his pocket. Okay, that's a vision of the future that Johnny Ive, who's gone to OpenAI, is trying to displace. Johnny Ive, who developed every Apple product you have in your pocket while he was at Apple for 20 years, is now saying he regrets creating the screen because he thinks it makes people not pay attention to one another. So he's trying to move the next device with generative AI backing to not be a screen. So that may not work, but if it does, Apple, that's a problem for Apple. That is an existential risk problem for Apple. So long as an iPhone and a screen are going to be sort of the user device of record and they're going to persist in 10 years, you might be right. That might be possible, what you just said. Apple can copy the best of Android, which will have Gemini, because Google has Gemini in every product now. That will work. But if Jimmy Ive and OpenAI are right and screens are going away, that's problematic for a smartphone maker.
I guess that's maybe where whatever they're working on for a face computer could come in. Laura, I want to go back to what you said about Gemini and Android because of the way that Gemini is baked into Google devices. Now, you say in your most recent note that Apple is a single product company. Its valuation risk is material if iOS falls too far behind Android. Would you say that iOS is already behind Android right now?
Oh, I would. Absolutely, I would. I mean, when you look at Google's, its revenue is accelerating over at Alphabet and its costs are going down. So its productivity per employee is going up. Why? Because 80% of engineers are using Gemini to do their first draft of code for new products. They're introducing new products faster. They're integrating, they over-delivered on advertising because they're integrating all these better both Meta and Google because they're using generative AI to increase the conversion rate. So yes, Gemini is being integrated into everything at Alphabet, Android included.
Does it matter? Like two comments here. One is the network effects that Apple has, and we're speaking with Laura Martin over at Needham, if you're just joining us. The network effects that Apple has, at least here in the US, are really strong, right? The blue bubbles for when you're on iMessage and the other Apple products that you have that ideally are supposed to work seamlessly with that. Plus, doesn't Gemini have an app that you can just use on your iPhone? So if you want to use Gemini as sort of a co-pilot here, if you are an engineer, you can just do it on your iPhone, but through an app that you'd get at the App Store.
Right, if it's standalone. But I mean, I think my guess is where Alphabet's going is they're going to integrate Gemini into everything on your device. It's going to know where your appointments are. It's going to know who your friends are. It's going to be a personal assistant integrated into your Android phone. Right, it's going to be a bigger idea than just a separate app where you go to it. It's going to be like, even if you listen to the meta vision of the world, super intelligence is about having a robot friend that does everything for you better than a human can. Make you, I mean, it's just, I think these are bigger ideas than an app store. By the way, some CEOs' visions of their apps are disappearing. So then you say, so what replaces them? Well, I don't know. Used to be websites. Then we went to apps. What's next? It may not be apps.
All right. You mentioned, I want to just get to Meta and Amazon. What about Meta? You know, in terms, I mean, that stock was just off and running following its quarterly update. Those ad sales numbers certainly catching everybody's attention. A mega spend when it comes to AI. What is your hot take on that one?
So stock up strongly, really strong fundamentals, 60% margins, 22% revenue growth, and a huge company, which was the fastest of the group that the big tech companies we call, really strong fundamentals. We are cautious on Meta, and that is because they took their capex to $70 billion this year and $100 billion next year. Again, no return in sight, and their stock comp per person is going through the roof as they hire super intelligence employees, with press reports saying they're paying $100 to $300 million over 3 years for each of these people.
Hey, pretty good work if you can get it, I'll say.
Yeah, my guess is they're trying to change the world, right? And they believe in super intelligence, which this isn't a vision of making you and I more productive. This is about replacing human beings with machines that teach machines. So it's literally Terminator, like life imitating art type of stuff.
Doesn't sound like you're pro AI in that context.
Let's stick to Meta as a stock.
Yeah.
My concern is that we're losing $5 billion a quarter on Reality Labs, and we're still funding the metaverse, and we're funding Quest goggles, and we're funding AR glasses, Ray-Ban glasses, and now we're funding a Gen AI competition with companies twice their size. All of that feels like a lot of capital spending to me, and actually cost to me, without a clear sense.
But
of
investors are saying they are okay with it up to now because they believe that Mark Zuckerberg has this vision for superintelligence, which, to be honest, nobody has actually articulated to me. Well, what does that world look like that Meta wants to create and thinks will be so profitable?
Aren't they okay just because the ad sales number came in really strong? Like, if it didn't, might everybody be like, maybe not okay?
Yes, absolutely. He is buying the right to spend money like a drunken sailor because his fundamentals in his core business are strongly over-delivering consensus estimates. The day that stops, the music stops. And suddenly people are going to take a hard look at these. You know, he's making 5-year commitments for these super intelligence employees, and he's making 10-year commitments with the money he's spending on data centers. So all of this money, he has a free pass so long as his core business is growing 22%.
Okay, totally makes sense. Sort of the free pass, like Elon was, allowed to be CEO of many different companies, and investors were fine with it until they weren't. Jack Dorsey, the same thing, right? It works until it doesn't.
Yep.
What about, though, the promise of this being profitable in the future, all this investment ultimately paying off beyond making ads more efficient? What is that vision? What does that world look like in your view, at least articulated by Mark Zuckerberg?
So Mark is just, he has got a big idea. He wants to replace Apple, that's for sure. So does OpenAI. So Apple takes a 30% tithe on every dollar earned on its platform. And that hurts Mark Zuckerberg, not only because Apple gets paid for a lot of work he is doing on Facebook and Instagram, but also it allows them to change policies and procedures like around security and safety and privacy that cost Mark Zuckerberg $10 billion in revenue 3 years ago. And since then, Mark Zuckerberg is all about replacing Apple or that piece of hardware with Ray-Ban glasses or Quest goggles or something, or the metaverse. He's trying to displace Apple, and he wants to be the backbone that everybody has to pay 30% to. So that's his main economic mission. And now generative AI comes along, which I think many CEOs thinks it changes everything. Even Apple said it's the biggest technological disruption of our lifetime. And they benefited from mobile, which you would have thought they would have thought was bigger than Gen AI, but apparently not. So I guess the question is, Meta is saying, we think there's super intelligence. We think every human being is going to have a robot that they hold on to, maybe without a screen. We don't know, we don't know what the form factor is, but that does things for you, where you see the world differently and it helps you get through the world. But I don't think we know what that is yet, and he doesn't either. That's why he's hiring 50 smart people to have train robots faster to do stuff humans can't do.
Well, nobody can do what you can do. We want to ask you about Amazon.
Sure.
This stock down still more than 8% here in the aftermarket. And I think there is concerns about kind of the cloud spend comparison, among the big hyperscalers. Amazon's still the biggest when it comes to, we think about what's going on in terms of the cloud. What's your take here, or what we kind of need to be thinking about with Amazon? Because investors seem pretty disappointed. Are you?
So I think here's what I think is going on with Amazon, to answer the first half of that question. So they had very strong revenue growth, up 13%, which was like, we were 4 percentage points below that, and very strong EPS and margins. But the problem is they gave very tepid guidance. So people are really worried about tariffs impacts here. So they're worried about the next shoe to drop. Their advertising grew very robustly at 23%, which is great. And I think that would have been higher had not Temu and Xi'an stopped advertising, sort of on April 10th, because they lost the de minimis rule exception. So I think that would have been higher, but that's a fabulous number nobody's focusing on today. And I think investors we've talked to are frustrated with capital spending on Kuiper, which has no revenue, capital spending for 10 years so far on Alexa, no revenue. And they're going to urban delivery same day. And I think people don't understand their core business of e-commerce. I think people don't understand that as use of capital. At the same time, they just raised their CapEx guidance, when you do the numbers, to round numbers 115, 120 billion this year. The next closest is Microsoft and Google at 85 billion. So they're quite a bit above everybody else on this generative AI thing. And then AWS has anemic revenue growth, 32% margins in the cloud business, and they were 39% 90 days ago. Like, what the heck? And they say they're capacity constrained. So then we would forgive them if they only report 17% revenue growth, but then why aren't your margins 60%? Why aren't they 40% again? Why not sell to the highest bidder the last, 1 gig of capacity? So we saw that in both Azure over at Microsoft and in Google Cloud. Slower, growth rates, but really high margins. And that just didn't play out at Amazon.
All right. Around the world we went. Thank you so much, Laura. Always appreciate it. By the way, Laura's got a buy rating on Amazon with a $265 a share price target. The stock right now just below $215 a share. Laura Martin, have a great weekend. Senior analyst at Needham Company joining us. Keep in mind, we're going to continue talking earnings in just a moment. It's not all about the Mag 7. We had some of the integrated oil majors reporting this morning. So we're going to get into that with Ellen Wald, author of Saudi Inc. That's just in a few minutes.
Before that, though, a check on the day's trade top business stories. Here he is, Charlie.
Thank you very much, Tim. Right now, ExxonMobil down 1.9%. Chevron among the companies out with earnings this morning down 0.2%. Apple, Amazon, just talking about those companies with Needham's Lynn Martin. We got Apple down 1.7%. Amazon down by 8.2%. 1%. President Trump says the U.S. is moving to nuclear subs to respond to what he calls highly provocative statements from former Russian President Dmitry Medvedev. S&P 500 index off session lows, but still down 1.5% on this Jobs Friday. The Dow down 1.1%. NASDAQ is slumping 2%. The 10-year 4.22%, with the 2-year 3.70%. And spot gold up $61 the ounce, up 1.9%. West Texas Intermediate crude down 2.8%, $67.32 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Both ExxonMobil and Chevron posted better than expected results after record oil production cushioned the impact of lower crude prices. This is coming in a week where we've got oil headed for its biggest weekly jump since Israel attacked Iran in June. Let's get to it. Longtime oil industry watcher, Dr. Ellen Wald, is back with us. She's president of Transversal Consulting and senior fellow at the Atlantic Council. She's also author of Saudi Inc., which talks about the history of Aramco and Saudi Arabia, joining us from Boca Raton, Florida. Ellen, great to have you back with us. Exxon Chevron's result last quarter, was it full of special caveats and nuances? Walk us through what we got from those companies and what it tells us about kind of the oil market and the oil business.
Yeah, exactly. Both of them, they reported earning drops. I think that was very much expected given how low oil prices were this past quarter compared to last year and even the first quarter. So that was very much to be expected. But at the same time, both of these companies are looking very strong, going forward. We've got Chevron's acquisition of Hess is finally has passed its final legal hurdle and is going through. And then, with Exxon's acquisition of Pioneer Natural Resources, it really looks good. They've got a lot of really good acreage in the Permian, which is considered highly profitable. Both companies are working together on offshore projects in Guyana that are also expected to be highly profitable. Chevron, its project in Kazakhstan also looks good despite all of these, slight snafus in terms of OPEC and production. It's generally looking good, especially as OPEC is expected to increase its production. The big question that we see going forward here, I think, is mainly oil prices. And the big question here is really, what is going to happen with this tariff business? I think the resolution or the deal with Europe has definitely brought some more stability to that. With this resolution of these tariff issues or these trade issues, come the expectation of more trade, and more trade is good for oil demand. So that's where we're kind of looking in terms of the market with that. I also think that the energy part of that deal is very, very good, obviously, for oil companies, especially in the U.S., considering how much oil and gas and other energy products Europe has agreed to buy from the United States. Really, the question is, can the U.S. actually supply all of that oil, given the fact that the amount that they're talking in terms of the dollar amount is basically like the total amount of oil exports that the U.S. exports already. So there's some questioning there, but overall, it definitely looks good for American producers and oil companies in the United States, even if the exact details of that, I think, remain to be seen and have to be hammered out. The other big question coming up is just this tariff and secondary tariff issue with Russia.
So that's the trade side of this. I'm wondering about the U.S. economy side of this. And it's kind of front and center today, at least when it comes to the jobs market, given a headline miss and the revisions that we saw over the last few months from the BLS numbers that we got earlier today. What, in your view, does a potentially weakening job market or cracks starting to appear in the job market due to the long-term demand picture for oil?
Yeah, so weeks in the job market, cracks and fissures there are definitely not a good sign for oil demand in the United States. And I think that we saw that with the weekly EIA report as well. There was some kind of, we would have expected higher consumption and higher demand for this time of year. Generally, the summer months tend to be higher demand. And what we saw was actually kind of weak. And in fact, some people were actually questioning whether this was a reliable number. But I think given kind of the revisions in the jobs report, I think we have to say that, yeah, this is definitely concerning. I think that it depends what we see going forward in terms of oil consumption, particularly as we're leading up to kind of end of summer, the summer finale, generally oil consumption goes up around then, gasoline consumption goes up. Will it go up as much as expected, I think is really the number we're looking to see.
Ellen, I want to go back to something you said about, what we get in terms of possible sanctions from President Trump when it comes to Russia. He has said he expects to hit Russia with sanctions on August 8th, so a shorter deadline for Russian President Vladimir Putin to basically halt the war in Ukraine. Those sanctions, as we've been reporting out, would likely take the form of tariffs on countries that buy Russian energy. So I'm just curious, tie together the importance of Russia in the oil energy markets, but also the complicated relationships, whether it's Russia, China, Russia, India, because it all kind of comes together.
Yeah, exactly. I think that, this is a really
just
big
about
ask.
A minute left, so I just want you to be able to manage that
This
time.
is a really big ask. I think that if we do see any kind of secondary sanctions on countries that buy Russian oil, either we're going to see these countries dropping their purchases of Russian oil, and that's going to put more demand on other oil sources, the U.S., OPEC, Saudi Arabia, et cetera. And that could definitely cause oil prices to go up in the short term. But if they decide that they don't care about this, then, we're just going to see more purchases of Russian oil, and that could definitely cause prices across the board to kind of deflate.
All right, going to leave it there. Ellen, thank you so much. Dr. Ellen Wald, president of Transversal Consulting, senior fellow at the Atlantic Council. She's also author of Saudi Inc. If you want to understand Saudi Aramco, Saudi Arabia, when it comes to the energy markets. Want to point out, WTI crude futures are up about 3.4% this week overall, still down about 4.5% on the year. But nonetheless, as we mentioned in the lead to her, we definitely have seen a move up in WTI crude.
A move up in crude overall, but a move down in stocks today with the S&P down 1.5%, the NASDAQ down 2%. An update, too, on that story we brought you just in the last half hour. President Trump said he was directing officials to fire the commissioner of the Bureau of Labor Statistics after a report showed that U.S. job growth cooled sharply over the last 3 months.
An update on stocks on the move when we come back on Bloomberg Businessweek Daily.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, you are listening and watching Bloomberg Businessweek Daily. I'm Carol Massar along with Tim Stenovec live here at Bloomberg headquarters. And yes.
What's the most read story in the last hour, Carol?
Does it have to do with President Trump about the jobs report?
It does. President Trump said he was directing officials to fire the commissioner of the Bureau of Labor Statistics just hours after a report showed that U.S. job growth cooled sharply over the last 3 months. Here's what he said. I've directed my team to fire this Biden political appointee immediately. He accused her without evidence of politicizing the jobs report. He said, quote, she will be replaced with someone much more competent and qualified. Important numbers like this must be fair and accurate. They can't be manipulated for political purposes.
Highly recommend, too, you check out our podcast feed or check it out at Bloomberg.com because we had a great conversation with our own Michael McKee, who has covered numerous administrations, numerous economic cycles, and a ton of jobs releases. So he really gives you the lowdown on all of that. In the meantime, we've got a market that we're off our worst levels of the session, but definitely off our best levels of the session. We are seeing selling on this Friday. In fact, down about 2% on the NASDAQ 100, a decline of 1.7% on the S&P 500.
I'm Tim Stenovec, and that is Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg News cross-asset reporter Denitsa Tsekova. Lot to choose from today.
A lot to choose from, but it's a big sell-off day, and we should start where it all started. The mood was soaring after Amazon earnings. I feel that's now it's down nearly 8%. Obviously, we've talked a lot about the report, but it's projecting weaker than expected operating income. And the biggest concern is that it's trailing the sales growth of its cloud rivals. Everyone has been talking about Amazon Web Services performance, which actually they reported sales climbed 17.5% in the second quarter. But what analysts are worried about is that the growth they're seeing at Microsoft and Google Cloud units is about 30% a year. So that's where we're seeing some of the reaction. The stock actually flipped to losses. Now it's down 3% year to date. One thing we're seeing is Amazon stock decline clearly reflects Wall Street frustration with the cloud. Amazon CEO was pressured by analysts on a conference call about the result and why their cloud service is not growing as fast as other competitors. And obviously this comes after incredible day for Meta yesterday. So the bar is very high for AI, and we can see the winners are rewarded very well, but small misses are hit pretty hard.
I will point out that we spoke with Laura Martin over at Needham. She's got a buy rating on Amazon, a $265 a share price target, so some significant upside from where we are today. And she continues to say that AWS's strategic position as a dominant cloud business segments with highest margins are growing fastest. Service revenue, she talked about the growth there, and so much. She says Amazon is a services company, which implies valuation multiple expansion in their view. So two sides to every coin. All right, let's talk about Moderna.
For sure. Another big decliner today. Shares are down about 8% now. It's coming off the company's cost-cutting effort, failing to calm investors. And of course, the big issue that has been ongoing for quite some time is the decline of their COVID vaccine business. Of course, the ticker is MRNA. Moderna lowered the high end of its revenue forecast. There is about a $300 million cut. They're saying that this is largely driven by shifting the timing of a contract revenue, but this is adding even more pressure. Moderna has been cutting costs to offset waning sales of the COVID vaccine. Their second quarter loss was narrower than what Wall Street expected, but clearly this didn't bring enough relief. Moderna has been forced to make steep cost cuts as demand for the COVID vaccine has been going down. Of course, it has a lot of pressure under the administration, especially with Robert F. Kennedy, which is a well-known vaccine critic, and U.S. health official rolling back long-standing recommendations about who should take the COVID vaccine. And combining all of this, the stock is down 35% this year and is really having a tough day today.
That's just this year, not to mention the COVID era highs. When this was the company, it was added to the S&P 500. It was minting billionaires. Right? It was a far cry from where it is today.
All right, got about 30 seconds for Coinbase.
Coinbase, which was also a pandemic favorite once, then it fell, and now it had a stable year, which was disrupted by earnings report. Largest U.S. crypto exchange reported lower than estimated second quarter revenue amid drop in digital asset market volatility. Ticker is COIN. Stock is still up 25%. That said, it actually fell in 6 of the last earnings report. One interesting thing is the legislation that moved through Congress. It was approved. Some analysts are saying that this may not necessarily mean a boost for Coinbase, saying that more regulatory certainty is going to invite more competition. Still, stock is doing well, but some tension there.
Yeah, down 16%, so a big move to the downside. Ouch.
Bitcoin taking a hit today too. Down to about 113,000.
Still doing okay this year, right?
Yeah, this year it's fine.
Yeah.
Since November, it's doing pretty well.
Bloomberg News cross-asset reporter Denitsa Tsekova. Check out our Stock Movers podcast, 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcast. Quick check on the markets, folks. We're heading into the last hour of trading for the day and for the week. We are down about 1.6% on the S&P 500 and a 2% decline, Tim, for the NASDAQ 100.
And coming up next, we're sticking with our coverage of the latest out of Washington, of course. The heightened tensions between the U.S. and Russia, Mag 7 earnings, what it all means. Gina Martin Adams next. The Close on TV.